This episode is brought to you by Paraswap, the leading aggregator to find best prices across various DEXs. You'll hear more about them later in the show.
We need to solve education around, owning a piece of the internet. That's how people understand that this is a massive opportunity that they want to participate in. And to date, they've demonstrated that their thumbs will learn, so to speak, which is what Steve Jobs said, to reporters that were criticizing the iPhone because it didn't have a keyboard, right? People figured it out because it was worth figuring out.
All right, everyone. Welcome to another episode of Empire. We have not one, but two special guests, and we're joined by Santiago. We got the whole gang here. We've got Jesse Walden and Lee Jin, both from Variant. For those who don't know Jesse, backgrounds in the music and media industry, founded Cool Managers to help artists expand their reach and their business. Then founded a crypto media startup called Media Chain Labs, got acquired by Spotify, went over to A16Z, then launched Variant, and then in October of 2021, linked up with Lee Jin when her fund Atelier, I'm sure I'm botching the pronunciation of that, merged with Variant Fund. Atelier, amazing. Okay, cool. And Lee was also spent some time at A16Z, has been investing in consumer platforms, marketplaces, networks, all that fun stuff. We're going to talk about creator economy, ownership economy, DAOs, NFTs. But before we do that, Jesse and Lee, welcome to the show.
Thank you, and thanks for having us.
+1. Thank you for having us.
Yeah, of course. I'm super excited about this one. When I think about Jesse, the first word that comes to mind is like ownership economy. And when I think about you, Lee, the first thing that comes to mind is the creator economy. So I think actually just a good starting place. I wanted to get your guys' take on how do you two define ownership economy versus creator economy? Is one a bucket inside of each other? How do you define it maybe internally? Do you agree on it? What do you think of Variant? Maybe let's start with the definitions of ownership economy and creator economy.
So I describe it as a Venn diagram where there's an overlap in the middle, but then there's also creator economy without ownership. And then there's a broader world of ownership economy that is outside of what people typically conceptualize as content creators. But there's definitely like an overlap where the creator economy is overlapping with the ownership economy. So the creator economy, to start off with that definition, I would define as like the economy in which people are creating content, building an audience on the internet, and then monetizing that in a whole host of different ways. And the trends around monetization and how people have built their audiences have changed over time. In the past couple of years, it's really shifted to direct monetization of one's audience. And so there's been the rise of all sorts of like direct monetization platforms like Patreon and Substack. And I think of NFTs and social tokens really as an extension of direct monetization opportunities for creators that involve digital ownership. And that's where you start to get into the overlap area. But yeah, broadly, the creator economy, as I think of it, is people monetizing their online presence and contributions in different ways. And historically, when people think about creator economy, they think about advertising and brand sponsorships, but it's increasingly about finding new ways of directly monetizing one's audience as well. And then the ownership economy, Jesse, maybe you want to talk about the ownership economy since you coined that term.
Sure. So, I mean, in one sentence, the ownership economy is the idea that all next generation internet products and services are making ownership a keystone of the user experience. And to Lee's point, this is happening across lots of different verticals. It is happening in sort of consumer tech and sort of, a subset therein, which is the creator economy. It's happening in financial marketplaces, in DeFi. It's happening in developer facing infrastructure. And it actually sort of played out in reverse order. So if you rewind the tape all the way back to 2009, Bitcoin's inception, Ethereum shortly thereafter, those were networks built, operated, and owned by users, and the early users of these networks were developers and technologists who understood the capacity for digital tokens to transfer ownership value to them, irrespective of their geographic location. All that was necessary was an internet connection, and this is, I guess, in some ways not surprising because Silicon Valley has known for a very long time, if you want to get the best technologists and developers to contribute to your project, you've got to give them ownership. And generally that takes the form of employee stock options. So the new thing here was being able to earn an ownership stake in a network or platform that was not originating from Silicon Valley, not using employee stock options as sort of the vehicle for distributing ownership, but instead using crypto tokens to distribute that ownership value directly to the users who are contributing it, in this case, developers and technologists. And there's this like age-old Dixonism that I always refer to that Chris wrote about 10 plus years ago, that what developers and technologists do nights and weekends is what the rest of us will do in 10 years. And so, having been an entrepreneur, like building an early network that was facing developers and then sort of starting to invest in the space in 2018, where we were largely focused on developer facing infrastructure, I sort of had the privilege of seeing what it is exactly developers were doing sort of nights and weekends and what the rest of us might be doing in 10 years. And that was, exactly what I said, building networks that they owned a piece of in exchange for their contributions. And so that was the spark for what became this broader thesis that this was going to be the future of all next generation consumer internet technologies. And we've seen that play out very rapidly across the markets. I mentioned, DeFi financial marketplaces and consumer marketplaces, NFTs, consumer social.
So when you guys are when you are seeing something like these NFTs, I feel like you both have been talking about this for many, many years, right? Ownership economy, passion economy, creator economy, and now it's just kind of coming to life. I think it was about a year ago that Beeple sold the NFT for 69 million, and now it's really just taken off. You have photography. I just collected my first one-of-one photography NFT. Like music NFTs are really taking off now, and I know you guys invested in sound. Why is now the time that all of this is taking place? When, Jesse, I think you started working on Media Chain in like 2014 or 2015. Like, why is March of 2022 the time that it feels like, okay, all of this is actually happening for the first time?
I think it's that there's just sort of a confluence of like cultural factors coming to a head, where, on the one hand, we've just gone through, massive internet adoption cycle broadly. This is sort of on a macro level, right? Like the last 10, 20 years, just people spending more and more time online. Two is a super sort of inflationary environment that's only starting to be appreciated right now, but was sort of very obvious to anyone paying attention, right? Which is, if governments print a ton of money, chances are there's going to be inflation that happened in a big way with COVID. And one of the results of that, of course, was the sort of like everything bull market of the last 2 years, where we saw, meme stocks sort of play out and crypto become part of the conversation in a really dominant way in financial markets. And culturally, I think, those two things combined to have a really big effect, which is a new kind of like consumer behavior emerge. And that consumer behavior is investing as a team sport that you play with your friends online, right? Whether it's GameStop or Dogecoin or NFTs, like investing is now a consumer phenomenon, and it's a social phenomenon as well. So internet users are better than traditional investors at playing this team sport because it's sort of being played on their home turf. So NFTs are cultural assets, right? Like, who understands how to invest in cultural internet assets? It's people who use the internet often, and it's not traditional investors. And so basically, you have this this new asset class emerge, this new sort of cultural phenomenon of investing as consumer behavior that lots of people participate in, and in therein you got the makings for a highly reflexive marketplace for these new assets that just compounded in on itself. Once you saw people sell that NFT for $69 million, it begat a whole lot more interest from other artists who then entered the market and other collectors who followed, and that cycle compounded.
Yeah, I would just add to that I think it really happened in early 2021. Like I would pinpoint that as the moment in which like a lot of this started to erupt and break into the mainstream. And I think another influence, in addition to everything that Jesse mentioned, is like I think the impact of COVID cannot be understated, and that as like a macro factor influencing internet usage, engagement on these social platforms. Like if you looked at any creator economy companies during that time period, post COVID, post lockdowns, like the numbers were all up and to the right. Every company that I spoke to was astounded at how all of their forecasts kept being beat month over month. Like just the numbers were beyond what they had ever anticipated because people were locked at home without anything to do for entertainment and to divert themselves. They consumed content from content creators. They tried their hand at being content creators on the internet. They tried to monetize in entirely new ways. They were questioning their existing careers and livelihoods. And so it was just this huge moment of upheaval in everyone's habits and lifestyles that then I think led to this surge in participation of retail investors, but also content creation online, people wanting to find new ways to monetize that online activity. And so I think a lot of that also played into it.
That's a really interesting point. You have this piece, Lee, about the 4 phases of the creator economy. You got like phase 1 is like beginning of the internet, blog posts, early social, posting on Twitter, things like that. Phase 2 is you build a huge brand on Instagram and all this kind of stuff, and you kind of act as a conduit, I think is the word that you use, for other brands. Phase 3 is you stop being the conduit for other brands and you move over to things like Substack and you kind of build this direct monetization with your super fans. And phase 4 is you move from the creator economy to the community economy. Can you just give us your view into, I think you actually have a better view into this than really anyone in the world. Like, where are we today? What does it look like today? Because to me, as this kind of outsider, but who's also in crypto, I'm not investing in the creator economy platforms like you guys are. I still see all these journalists and things like that moving over to a Substack. I still see things like Substack becoming really big. But to you, you guys are on the forefront. And it feels like what you're looking at is people maybe moving away from the Substacks of the world and starting to move into actually building user-owned platforms. But would love to just hear your insights into where you think we are in this timeline and where we are in these phases.
Yeah. This was a tweet storm that I published maybe a couple of months ago. And I said that we are currently sort of in the later stages of Creator Economy 3.0, which is creators as their own brands, finding ways to monetize their followings in new, novel, direct ways. And then we're on the cusp of this transition to the community economy, phase 4. So I think in terms of where we are in that transition, I think it's still early, but you can see examples already occurring of creators who are co-creating and sharing value back to their communities. And to actually back up a moment, to frame this idea. So, I think a lot of people describe, like Web 2 versus Web 3, sort of philosophies and like design as being, like the Web 2 platforms being value extractive, from their participants. They are, there's the owners of the platforms, and then there's the participants on top who are leveraging them to earn income, but don't actually own or have any sort of governance rights over the underlying platforms themselves. Versus Web3, in contrast, there's oftentimes a vision of co-ownership and co-stewardship of the platforms themselves. Well, I think there's also a parallel to that in the creator economy, where today the creators are kind of the underlying platforms and they're extracting from their fans on top. Their fans are sort of the ones who are responsible for the success of the creator in the first place. Like without the fans, the creators can't be successful by definition. And yet the creator is capturing the value. Like the fans are paying out, money from their own pockets, and the creators are accruing that value. And all of these dynamics sort of belie the actual nature of contribution and work on the internet, which is that everyone is contributing in their own ways. like everyone is a content creator to some degree. Everyone is a creator and contributing to some degree. It's just that all of those micro contributions aren't being adequately measured or rewarded or compensated in any way. So today, if you think of creators as the platforms and the fans as being the party that is sort of responsible for the creator's success, but not actually accruing any of the value from their success, then I think the next phase of the creator economy, the so-called community economy, as I mentioned, is one in which everyone's contributions is rewarded and recognized and valued, and everyone is able to benefit from the upside of their participation. So to make that more concrete, what does this look like? I think it looks like, this is already happening. Like, creators are already turning over some decisions to their fans. They're already taking input from people who then feed into their content creation. Like, when I write a blog post, I oftentimes crowdsource examples from my Twitter followers. When I can't think of any examples, like, I just pose that as a question on Twitter, and then hundreds of people respond, and I weave some of those into my blog posts. They don't really get any sort of value back from that today. But I think the audience is already a core part of content creation. And so I think where all of this goes is that everyone has some stake in the success of that co-creation and is able to benefit from it.
And to that point, do you think that there are certain use cases that might be more suitable or I guess would gain more traction than perhaps like social media applications like Twitter? I mean, the energy to create a new social network seems high, although not impossible. In this example that you just mentioned, you're still using Twitter. There have been attempts to decentralize social networks. You have kind of I'm curious to get your thoughts on like the curation aspect of it. Like in a totally kind of permissionless world, you can have some pretty weird stuff in the sense of like there's no censorship, there's no like curation. Like obviously there are scams in NFT land where it seems to me like there's an influx of creators, some of which might not, like there is value in curation. And so I'm curious to get your thoughts around like, do these worlds, like in this new kind of Web3 world where community ownership is important, like where does the value of curation and like come into play?
We were discussing this topic last week during the Lens Protocol hackathon. Basically, I think the vision and all of this is like very much, at some level it's all a hypothesis because it hasn't been played out yet. But I think the vision is that curation will be a function of users voting with their feet. So what you have in this new paradigm of decentralized social media is all of the underlying data, including the content itself, the social graph, your relationships, your identity, that's going to be publicly accessible and open as basically a public utility. It's going to live on chain. And then various developers can compete to build applications on top of that, and perhaps different algorithms to surface different types of content to users in different feeds. And so versus today, where we have just a handful of social media platforms, each with their own siloed databases, you could have a multitude of different applications that compete on the basis of having perhaps the best curation or being tailored to a certain interest area or weighting your social graph differently or something like that. And so the place for curation, I think, is at that layer on top where users are opting in to decide, like, I want to use this application that provides this level of curation, or, information is more or less like verified than this other application. I think the interesting question that arises from that is like, what happens to misinformation in that world and the propagation of things that like information that has not been verified or is just like patently false. I think that's still an unsolved problem.
Although to be fair, Twitter, especially Facebook, I remember during the election, it's kind of impossible for them to I mean, they have a team that is trying to verify fake news, but that's not to say that they've solved the issue. Like they struggle
Right.
with this too as well. And so, I mean, perhaps what you're saying is the community might take, when you're part of a network and you have ownership, then perhaps the optimist in me says, well, people are going to be more incentivized to verify and maybe get rewarded if they are taking down fake news, and if like wisdom of the crowds kind of like converges on the truth versus like, you know, a team of 20 people on Facebook headquarters trying to verify, you know, news from different sources.
Lee, I saw one of your posts. I think it was actually after the Lens Protocol hackathon, or maybe before. It was in relationship to the Lens Protocol. You said the biggest opportunity that exists now in crypto is creating social networks that couldn't have existed in the previous paradigm, new networks that can exist but currently don't. And then Jesse, I was thinking back to what you were building with Media Chain, which was really a decentralized backend for media platforms, is the way I kind of understand it. A little bit like all the content is on one place and it can kind of get propagated to different front ends and things like that. When you maybe Lee, if you want to start here, like why is this? What does a decentralized social media even look like? Is it that the users' identities are all stored on chain and then the front ends are just kind of different, like DeFi, or where money is stored on chain and the front ends and the actual actions that you can take on platforms is different? Or what does a decentralized social network look like? And do you think that it looks a lot different than something like an Instagram and a Twitter, or does something like Twitter just almost move on chain?
Yeah. So the reason why I tweeted that, or like that quote that was pulled from the hackathon discussion, saying that the biggest opportunity is to build like net new consumer experiences that couldn't exist in Web 2, and that basically I was encouraging the participants in the hackathon to like think bigger, think beyond what currently exists, instead of trying to like port, you know, an existing like Twitter or Facebook or whatever and just bring it on chain. Challenging them to think of like what are new applications that could only exist in a decentralized paradigm. So I mean, to provide additional context to that, my personal view is that Web 2 and Web 3 are going to coexist in the future. Like, I don't think Web 3 supplants all of the applications that people are using today. I think they still have their time and place. I think they're good for the specific things that we seek from them. Like, they have a job to be done that they do well. Like, existing social networks are really good for status signaling, or today, like broadcasting your thoughts to the entire world. You know, there's 3 billion users on Facebook who can see your posts. And so I think trying to compete against Web 2 applications on the same dimensions, like head to head, is kind of a losing battle. So instead, I think the opportunity is to build entirely new applications that can't exist today. And so an example that I gave during the hackathon was there are social networks that do not currently exist, that should exist, that have had issues going from 0 to 1 and reaching the level of liquidity in their network in order to provide an interesting and compelling consumer experience. So an example of this would be, there still is not a local social network. There's no social networking application that lets me know, like in a 5-minute radius of where I am right now, like what is going on in the world. That just simply does not exist. There's no place on the internet that I can go to find like what is happening 1 mile away from me right now. And various developers have tried to build that experience, but none of them have like overcome the cold start challenge of like getting enough users on for that network to tip. And I think like that is the beauty of token incentives, of like helping to get a network beyond that cold start challenge and getting it to the level of liquidity that is needed. So that was one example that I gave of like thinking beyond what currently exists. And then I think more broadly speaking, like I oftentimes describe like blockchains as social networks already. They are already networks in which people are interacting with different accounts and engaging in transactions, but there's always a value associated with every interaction. And so internally, we've described this as it's a social network with skin in the game versus a social network in which people are just self-reporting or like posting content that could or could not be like real. They're doing it for status on existing social networks because the cost of doing anything is completely free and frictionless. But on a blockchain, everything has value associated with it, and people are taking actions with real skin in the game.
I'm going to push back a little bit just because I think the 2018 crypto person in me that's like when I entered into the industry, and that like almost left a very skeptical view in my head of like decentralized social media, because it was like Steemit was all the rage, if you guys remember Steemit. And it feels almost like maybe a skeuomorphic idea that it's like Uber on the blockchain. It's like, all right, putting Instagram on the blockchain. So Jesse, when you think about decentralized social, what does this look like to you? Is it moving Twitter and Instagram onto the blockchain? Is it kind of like what Lee said, where there are these other social networks that should exist but just don't? Or is it something completely different that we're not thinking about?
Yeah, it's definitely more aligned with Lee's point of view. I think I'm not a fan of anything skeuomorphic or trying to take X and decentralize it. Rather, the focus should absolutely be on building things that benefit. But from the properties of crypto, which are again, ownership as a keystone of the user experience, or something that is only enabled uniquely by the technology. And so my sense is, social networks are gonna take a different form, and some early examples of that today are some membership groups that are affinity groups that I think are forming around asset ownership. So there's friends with benefits where they aim to be sort of like a social club for members who own a token and are aligned around the idea of growing that token's value, growing the value of the social network. And when I say value, I don't only mean financial value. That's one of the unique things about crypto. These are not corporations, right? So corporations have one singular value, which is to maximize shareholder profits, right? Like that is the reason that for any corporation. Crypto networks are not corporations, so they have the opportunity to define value however the members would like to. It could be financial value, it could be financial plus some kind of other social value. And Friends with Benefits is a good example of a community that's sort of evolving their values in real time, and creating sort of a social network that lives on top of, but distinctly from the Web2 social platforms that create Schelling points for people to jump into this new kind of social network. I think you're seeing the same kind of thing happen in NFT communities where membership is gated by owning, a punk or an ape or, a noun. And so these are, I would describe, sort of new social networks that exist on top of existing social networks where people are, for example, displaying those NFT, membership badges as their profile pics. This is like the early incarceration of a new generation of social project. And zooming out from social specifically, I think another framework here is that crypto enables a very wide array of new kinds of networks. On one end of the spectrum, it enables networks that are way bigger than any Web2 platform could ever dream to be. So the idea of internet money is a network. Money is sort of the biggest global network in the world, right? It's the idea that there's going to be sort of a global internet money is much bigger than even the biggest social media platform or internet platform in Web2 could ever dream to be, and it only can exist because of decentralization. Like, it doesn't make sense for a corporation to issue internet money because it's not credibly neutral. So that's an example of a new kind of network, uniquely enabled by crypto. On the other end of the spectrum, there's going to be an extremely long tail of networks that didn't make sense to build in the Web2 environment, because the coordination costs were too high. Right? Like one example is the one Lee threw out earlier, like, a social network for what's happening locally in my city. The coordination costs were too high. How do you get that to tip? I think other examples might be, you want to create a guild of, 6 talented designers who each live in different countries, right? And really want to work together. They met online, they're great collaborators, and they're building digital products. But, coordinating 6 people in 6 different countries to set up an entity, set up bank accounts, it's very high cost, high friction, not going to happen easily, right? Crypto, it's just a smart contract. So that's a new kind of network on the complete other end of the spectrum, where that it didn't make sense to form that network on the legacy rails, but crypto uniquely enables it. So I think we're going to see this, this sort of bifurcation that will play out across, many different types of verticals, but social is one of them where you will have, membership groups that are absolutely massive, and others that are extremely long tail.
Tying together an idea from Jesse, an idea from Lynn, and I'm sure what is a really bad idea from me, which is, Jesse, your idea of like money as the largest network. Lee, it makes me think about something that you said in the January episode with Bankless of what was it, Mark Andreessen, like the original sin of the internet. We see like 404 errors, but really there could have been a 402 error when we tried, but this is, I think, my understanding is like we tried to embed payments into web pages, but like it just never really took off for several different reasons. When I think about like what the future social network should look like, it's having money embedded directly into social, which actually kind of already exists. Like if you take a different lens on social media, Venmo, I guess you could almost say Venmo and Cash App are massive social media companies in a way. And so I'm curious to get your guys' take, and it's never a good idea to come up with new ideas on a podcast, but what would you guys think if you guys saw like a pitch or something like that for a new social network that maybe looked something like a Twitter or an Instagram or something like that, but there were native payments directly embedded into the network, almost like a Venmo Cash App meets like a Web2E type of social network? Good idea? Bad idea? What are we thinking?
I mean, I think what you're describing is basically a blockchain. Like that is essentially like a feed of transactions that are happening among people. And you can sort of see anyone's interactions with any other account. I think the beauty of a blockchain is like there's so many different types of assets and tokens and like applications that people are interacting with. It's a much richer consumer experience and design space than just your Venmo feed or your PayPal feed. I think people often comp Venmo to a social network, or they point out PayPal as a social network, but I don't know the actual stats, but I really doubt that they have as high of engagement and usage as like a content-driven social network. And that's because content is just inherently more expressive, and therefore people can do more with it and create more interesting stuff that draws in more users, and people come back for that. Versus individual financial transactions being sent between your friends, like there's just a much more limited, like creative expression that you can do through that. So I agree with you that there are like social networks that are built around payments and financial transactions, but I think it looks more than just what we see in Venmo.
Yeah, I think actually a really good example is something like Context, which context.app is the website. And if you go there, it'll look like pretty familiar in that it's it's a visual feed of images, not unlike Instagram or Tumblr or some Web2 social network that you'd be accustomed to. But the thing that's different is each unit in the feed is not a JPEG, it's an NFT. And the caption is not so-and-so posted this, rather it's so-and-so did this action on chain, like so-and-so bought this or so-and-so swept the floor, right? So these are, again, to Lee's point, blockchains are social networks, right? They're feeds of transactions, they're economic links that are being forged between people, and that's inherently social. Money is the biggest, network. You could argue it's the biggest social network or socioeconomic network. And blockchains are the same thing. And so what Context is doing is just visualizing that in a human legible way, right? A visual way. So that's really interesting to me, and I think is as close as I'll come to saying that the future of Web3 social looks similar to Web2 social. It looks similar in its presentation, but again, there's a ton of nuance and important differences in what's happening in the feed. Each unit is skin in the game. It's something that already happened, verifiably so, and something that you can also do yourself. So if I see, Santiago purchase X NFT, maybe I can, mirror his trade, for example, right? I can follow him in that economic way, not just in a, superficial social way.
Empire is brought to you by Paraswap, which just reached a whole new level in the DeFi game. Paraswap started as a DEX aggregator, which, for those who don't know, it's like a Google Flights or an Expedia for swapping crypto. You would obviously never just go directly to an airline's website. Same thing with crypto. You would never go directly to an exchange to trade or to swap. You'd go to Paraswap. Why? Because they aggregate liquidity from more than 60 different sources to get you the best prices and the most efficient gas transactions. Now, Paraswap, obviously still the best aggregator out there, but now there's more. They now have staking, they have yield farming. There's this one feature that I love. It shows you exactly how much money Paraswap saved you on your last trade. They're now on 5 different blockchains. They've got Ethereum, Binance, Polygon. They recently added Avalanche and Phantom. So it's really simple. If you're an Empire listener, if you are new to DeFi or you're a power user of DeFi, really anybody, if you're dabbling in DeFi markets, you have got to try Paraswap. Their new staking and yield farming products are a game changer. They've taken DeFi to the next level with really one of the first mature DeFi products that I've ever seen. So head on over to paraswap.io. That is paraswap.io, and start swapping, trading, staking, and so much more today.
Okay, so a creator listening to all this is certainly, it resonates with a lot of people. Owning, getting a more equitable distribution that is tied to the value you provide as a user, as a content creator. Like, I think like a lot of people at this point don't contest that, don't disagree with that. I think the criticisms that we constantly, I think at this point, at this juncture where crypto is in the adoption cycle is the ease by which you can use these protocols and these networks. And so I'm curious to get your perspective, what you're seeing on the ground when you think about social media applications and, you know, things that are tied to NFTs. Do you think that crypto in this cycle, or, you know, how far out are we from truly kind of reaching mainstream adoption? And I guess you could argue that NFTs have, to some extent, or gaming, like something like Axie, has gotten decent traction, but I wouldn't think that we're yet in mainstream kind of phase. But I'm curious to get your thoughts on this.
No, I think we're very, very early in the early majority adoption cycle. So I think it's fair to argue, maybe said differently, we're somewhere in between the early adopter phase and the very beginning of the early majority phase. And, you know, there's this great sort of bell curve of, you know, a very steep ramp up in early majority adoption, and then sort of you plateau, and then there's the late majority, right? That sort of comes on later. And growth is slowing at that point, right? You know, that's where I'd say we're at. But I would caveat, but you know, a lot of people take this to mean that, you know, the primary problem to solve is, you know, somehow dumbing crypto down, making it simpler, abstracting it completely. You know, our arguments that, you know, it should disappear into the background. And on the one hand, I'm sympathetic to that point of view. You know, I think crypto succeeds when we no longer talk about crypto, just like we no longer, you know, distinguish between, you know, internet products and services. There's just, you know, there's apps that we use, right? And like, you know, we don't talk about Uber as like internet cars, for example. We do talk about, you know, NFTs as digital collectibles or you know, crypto collectibles or whatever. So there's some degree of sort of abstraction or fading to the background that needs to happen. But I would say the other thing that has been pleasantly surprising in this cycle, and I actually tweeted about this morning, is the degree to which culture has met crypto where it's at, rather than crypto having to cater to the current culture, right? So like, you know, you have Snoop Dogg dropping on Sound because he understands crypto, and he understands, you know, that there's money to be made and that his fans will engage him there. Right, so he's willing to take a chance, be an early adopter, or arguably, you know, one of the early majority adopters, and bring his fan base to the platform rather than having crypto try to cater to where his fans are already at. So I think there's some degree of I would say the primary problem to solve is education. The vast majority of people don't understand the value of ownership because it's not something that's been accessible to them before, right? Like, you know, the American dream is to own your house. Never before has it been possible to own a piece of the internet. That's now possible for the very first time, and people are starting to wake up to that. You know, it's one it's one hop to understand, oh, I can own this JPEG, or I can own, part of an NFT collection, to suddenly I can own a piece of every product and services that I use every day. Right? That's like one leap that, educational leap that most people are still yet to make. And so when I think about the synthesis of, we need to simplify crypto, and versus the hypothesis that crypto is, going to be met by culture rather than cater to existing culture, the synthesis is that we need to solve education around, owning a piece of the internet. That's how people understand that this is a massive opportunity that they want to participate in. And to date, they've demonstrated that their thumbs will learn, so to speak, which is what Steve Jobs said, to reporters that were criticizing the iPhone because it didn't have a keyboard. Right? People figured it out because it was worth figuring out.
What are the unintended consequences, or maybe the downsides of this? And maybe that's the wrong way to put it, but I was reading this Mr. Beast thing that he put out, like Mr. Beast, biggest creator on YouTube, right? And someone who was interviewing him, I forget who it was, said, "Do you want to own, like, why?" They first said, "Why don't you go move onto your own platform? Why don't you create your own platform?" He's like, "Because I love YouTube. YouTube's given me so much." And then they're like, "Well, should YouTube give you equity? Should YouTube give you ownership?" Obviously, he could just go buy Google stock or Alphabet stock or whatever. But he's like, I don't want to be an owner. He's like, I have no interest in being an owner. I am an owner of my own business and these platforms. He's like, I don't need to be an owner in YouTube. They're doing a phenomenal job. I get paid $100 million a year. And so is there, I guess, the downside part of this, like the early part of this question about like downsides and unintended consequences of making everyone an owner in Web 2, like not everyone becomes an entrepreneur. Not everyone's an owner, because you're basically you're levering up your risk reward. If you're an employee, your risk reward is like, it's in this range. If you're an owner, your risk reward is in this range. So do we have the same kind of 10x amplified risk reward when everyone in society becomes an owner?
I get this a lot, by the way. There's a lot of like staunch traditional creator economy people who respond to the writing that I put out there and some of my tweet storms, and they're like, creators don't want to own, or they are not qualified to be owners. Like
Lee, you're basically calling me like a boomer Web 2 person here. I understand how it is.
I did not say that about you. I'm not going to name names. But like, I do think there is like, I'll say this, like ownership is really multifaceted. When we talk about ownership, it's not this monolithic conceptualization that we have in mind. I think ownership comes in many different flavors, and there's lots of different ways to design what ownership looks like. So when people say that creators shouldn't be owners of these platforms, I think what they're referring to is they shouldn't be responsible for the product roadmap or feature decisions of that particular platform. So they're talking about governance as like one particular component of ownership. But then I think there's this other side of ownership, which is economic rights and claims to future cash flows. When people invest in businesses or invest in the stock market, that's really what they're looking for. I don't think anyone ever participates in like the shareholder votes for public companies that they're invested in. So the economic component of ownership is another separate dimension that I think most people actually do care about. And I think you'd be hard pressed to find anyone who would argue that creators shouldn't have economic benefits from their participation and usage of these networks. Like, I don't think Mr. Beast would be very happy if he used YouTube and drove so many views, but didn't get paid a cut of their advertising revenue, which YouTube now gives to creators. So I think ownership exists on this like spectrum of level of owner responsibility. And also there's like different dimensions of that responsibility. There's economic benefits, there's governance responsibilities. And so I think it's like this huge design space on which you can create like the right type of ownership experience for the users. But what we're saying when we talk about the ownership economy is not necessarily that every single person, every single participant needs to have their voice be an input into every single micro decision of these products.
Do you think that the quality of content improves dramatically? And what I mean by that is, on one end of the spectrum, I think that if you're the life of an influencer is initially you put out really authentic content, and over time that gets corrupted because you sort of need to understand that, like, because you're not being compensated as well using a platform like YouTube or whatever, it just, you end up selling to a brand, you end up partnering with certain brands, and then it tampers with the authenticity of the content. I think, to sort of this curve. And so if you're getting a higher share, if you're connecting directly with your audience, and you might not need to sell out to a brand, you might just continue to be really authentic and thrive that way. So that's one end of the spectrum that I think is pretty interesting when it comes to directly engaging with your audience, whether you're an artist or whether you're an influencer or of fashion or whatever. On another end of the spectrum, we have this influx of NFTs where everyone is now creating some sort of art. And there feels to me like that side of the market, I don't fully understand it, because I think there is a lot of speculation. I think there's a lot of people that are just flipping JPEGs and want to profit off of that. And there's a supply influx, and the quality is not necessarily there. It doesn't feel sustainable. And so I want to kind of transition here into how you think about investing at Variant in thematically, where you see kind of the biggest opportunities in this market. What feels more endurable, sustainable, to capture kind of this new wave of creator ownership economy?
I think the entire history of the internet has been one of a proliferation of content as a result of lower barriers to entry over time. And the lower barriers to entry catalyzes more participation, which then means that overall the quality of the best content out there is always improving. So I tend to point to the example of like TikTok versus Quibi. One was crowdsourcing content from all over the world, from content creators from anywhere. As long as they had a mobile phone, they could participate in the TikTok network and post content there. And that content ended up being a lot more engaging and higher quality than the content that was created top down by this one individual company. So I think overall, like when you lower the barriers to entry, I think there's real creativity network effects that arise where people then build on top of each other, and overall content quality tends to improve. I think the other question is like, how does business model impact content creation and the quality of output that you have out there? And I think that's a really fascinating topic. There's the quote, I forgot who it's from. It's like, show me the incentive and I'll show you the outcome. I think for a long time, the incentive was to appeal to brand sponsors and advertisers and to make content that would align with their interests and be easily monetizable through advertising. And that obviously impacts the type of content that people create, the look and feel of their content. I've had a conversation with Hank Green, who's like a big YouTuber, about how we think part of the differing cultures of Instagram versus TikTok actually arises from their business model differences. Where Instagram, you have to go outside of the platform, seek brand sponsors in order to monetize as a creator, versus on TikTok, there is the grants program, the TikTok Creator Fund, where they're just paying you if you get a lot of engagement and time spent. And so obviously the incentives are different, and that creates the motivation on the part of creators to create very different types of content. And then for transitioning to how we invest, we're investors across the entire crypto landscape. We call ourselves a generalist crypto fund comprised of specialists, where each of us is very much aiming to be an expert on a particular domain or subcategory within crypto, but we're investing across the spectrum wherever user ownership is being utilized as a driver of new experiences. And that encompasses consumer, but it also encompasses new financial marketplaces, developer infrastructure, new layer ones, etc. So we invest across the board.
Leah, I want to go back to your concept on just ownership and almost like what the Web2 boomer here got wrong there. And it ties back to this piece actually of Jesse's that I always reference and actually send it to a lot of founders, which is Jesse, I think this was you at least, progressive decentralization. I think you wrote it like 2 years ago on A16Z's site. It was like progressive decentralization, a playbook for building crypto apps. And there were three, you know what I'm talking about? It's like you had product market fit, and then you had community participation. And then there's, I think you called it like exit to the community. That was written 2 years ago. Do you still give founders a similar playbook? And do you still think that that is the right playbook? And can you almost just actually give an overview of your advice there?
Sure. Yeah. So short answer is yes. I still think it is like the right high level framework. I think we've learned a lot between the time that piece was written and today, in terms of like the specific implementation details of how to progressively decentralize and sort of do it well. And I think, this is very much an evolving playbook where the best practices are still, yet to be elucidated or like in progress of being formed. But the high level idea in that piece is just simply that, when building a sort of user owned and operated network, you have to start by building something that people actually want. And in that sense, there's really no difference between a Web3 startup and a traditional startup. Like if you build a product and no one wants it, it's going to be really hard to find users. They're the examples in crypto that have sort of gone about this the wrong way are those that have like started, for example, with just a token sale and then said, we'll build the product later. And in the very rare case that can work, there are a few exceptions. Like I think, well, maybe I won't name specific names, but there are examples of communities that have, bootstrapped something out of nothing but capital formation around a token. But I would say those are the exception, not the rule. And the rule is more so that in order to innovate and create sort of a new product that makes an impact on the world, you have to start by executing really fast and sort of moving quickly, iterating based on real user feedback. And it's just really hard to do that when you're trying to form consensus by committee. You do need sort of strong opinions weekly held, and generally that means a little bit more sort of traditional control over how decisions get made. And so the classic startup structure tends to work best in my view. But the thing that's different about crypto startups and Web3 startups is that, once you have early signs of product market fit, the trajectory for the project tends to change. In traditional Web2 companies, once you have product market fit, you go out and raise a bunch more venture capital in the hopes of growing the product or service, in a blitz scale like fashion. And all that capital is taken into the company, at the cost of dilution to the founders, the early investors, with the expectation that that dilution is acceptable because it will be used to grow the pie for everyone. So owning a little bit less of a bigger pie is better, right? Well, crypto takes that same principle but kind of flips it on its head. So what happens is founders find early product market fit. They hopefully have users of their product, and then they go and exit the ownership of the product to the users directly, which is also dilutive to the early founders and investors, but done for the same reason that that more venture capital is raised in traditional startups, which is that is a way to grow the pie for everyone, is to get more users involved and aligned with the success of the product long term. But the key thing that I think a lot of projects have missed over the last 2 years since writing the piece is that last utterance I made, which is long term alignment. Right, you need to get users, aligned with founders, investors who hopefully are long-term oriented around the success of the product, not flash in the pan mercenaries who come in, use the product, and then leave it for dry once the incentives have sort of run out. And so early in the DeFi summer wave of 2020, which happened shortly after I published that piece on progressive decentralization, you saw tons of projects exit to their community through liquidity mining programs where there was no sort of long-term alignment with users, right? Like users were in fact treating the tokens they were earning in exchange for using the product as just yield, short-term yield, that they were then dumping for ETH or USDC or whatever, some other coin that they were denominating the yield in. Nobody was thinking long term about the platform value that that could be accrued if they treated these tokens as long-term investments. And I think today you're seeing a lot more thoughtful distributions of ownership that reward people who can be long-term by either locking up tokens or sort of having them vest and drip out to users over a longer period of time. And so, directionally, I think that's something that needs to get written into the progressive decentralization playbook of 2022. And we're actually doing some work on that right now, sort of analyzing a lot of the distributions that have happened over the last couple of years, which sort of mechanisms worked well, which ones didn't work well, and sort of what results in the long-term sustainable growth and retention that these projects are seeking.
Yeah, I'd like to talk about what we're seeing with NFT communities, particularly Bored Apes. It has felt to me that this is a very interesting kind of inverted model of building, whereby you did a NFT sale and it's created perhaps the most strong community out there, or one of the strongest communities, and perhaps the most diversified community in crypto that touches the real world, that you're seeing lead to your point of this creative innovation. You have people using this Creative Commons and using Bored Apes in coffee shops and a bunch of other products and services, and it feels to me like what's stopping them from being the most popular DeFi platform if they decide to build a DeFi application or tap into DeFi or build a layer one. I remember joking, there was some speculation. I'm involved in Pleasure DAO, and I think you guys are too. And so we were talking, okay, what's when we bought the Doge rights, we said, well, what's stopping Doge as a network of transitioning to proof of stake and building the most widely used network out there? So I'm curious to get your thoughts around NFT communities and, capturing the value of the community and then building products and services around that.
When Bored Ape launched, they launched with this collection of art, right? These JPEGs of unique apes. But they also launched, this clubhouse, right? And which was their conception of a product. It's sort of a novel, Web3 native product, but nonetheless, it was a preconceived product built by a core team at Yuga Labs, right? And that was sufficient for early product market fit. So through this lens, right, they did progressively decentralize. They built sort of a minimum viable product that people want. They found some product market fit with an early community, and directly sort of made their users owners sort of all in one fell swoop. Like they published the JPEGs, they published the story, and they had the sale of the NFTs. Nonetheless, these three steps were sort of present in their playbook. Since then, a lot of stuff has happened, right? Like the community has grown exponentially. The value of the apes has grown exponentially. You have people building businesses around their apes, which they own, right? And so, I think this is a great example of what can happen in a permissionless sort of environment where people truly own their assets, and they can't get rubbed. It's sort of like what I think an analogy I've always come back to is that the way crypto networks evolve is very much like the way cities evolve. You move to a city because there's a critical mass of people, there's infrastructure there, right? There's utilities that you can plug into. And you can buy some property if you're fortunate enough to do it, and then you can build a business, right? And that business benefits from the network effects of the city. I think people participating in the Bored Ape community today are doing so for similar reasons. They're moving to the community because there's a critical mass of people there. There's some baseline infrastructure, which maybe is the apes and sort of the shared lore, and then they're building businesses around the assets that they own. And Jenkins is a great example. It's an ape, and the owner is building this whole sort of like entertainment experience around Jenkins the valet, right? So I think the lesson to be learned here is that when you go through the process of progressive decentralization and you do it well and people are long-term aligned with the success of the project, really amazing things can happen. You can build networks that grow bigger faster by virtue of people sort of taking it upon themselves to invest in and expand the economy of that network. And again, that's very much like how the same way a city grows. So, if you, and Dixon likes to make this comparison, I think it's great. If you compare that to like Disneyland, of course you can't build a business in Disneyland because Disney, the company, owns it, right? So that's why I think, cities are a good analogy, because they're completely permissionless, open economies that anyone can build on top of.
I think it's really interesting to diff Bored Ape and what has happened with that community versus all of the other myriad NFT collections that have popped up over the last year but have faded out. I think as I listened to Jesse describe the Bored Ape sort of factors of success, I think it hit upon like the right combination of like centralization and decentralization in combination, actually, where from day one, there was this very actively engaged core team who were proactive in creating the storylines and experiences. And I remember the initial website with like, I think there was like a bathroom in there or something. Anyways, there were a bunch of different like rich experiences that you could access only if you held the Bored Ape token. And so from day one, there was like a reason for people to want to join. And then I think there's also like a little bit of a butterfly effect where there's a path dependency where depending on those initial members who are part of the community, either additional members want to join or not because they see who is already involved. And so the path that like Bored Ape trod has led to its success versus, you know, like everything else out there that has maybe faded out or not have had the same level of continued engagement among their token holders. I think perhaps they didn't have that combination of like, maybe they were too decentralized from day one, expecting their community members to be engaged from the get-go and create a lot of those experiences from the get-go. And secondly, like, I think there's like network effects are like capturing lightning in a bottle. And I think Bored Ape captured on something where like the initial members were, like, yeah, the initial members were a community that other people wanted to join versus I think a lot of other NFT communities didn't have that. And so tapered off.
And I think critically that was, that was managed to a degree, right? Like there was a go-to-market strategy that pointedly tried to get specific people in the community to bootstrap that network. So again, through this lens, like there was progressive decentralization, there was sort of premeditated a plan executed by a core team to build a decentralized network that would contribute more value over time.
No, absolutely. I remember talking to those guys, and they this is around ETH Paris last year, and they were seeing some really interesting stats of total people that had never touched crypto come into their community and say, what do we do now? We want to talk every DeFi protocol. We're gonna, I think their vision was probably the most ambitious, and I think they've executed that in a very kind of impressive way. They've now obviously recently launched a token. They started as a collection of NFTs, and they built a really nice community. How do you think about it in this context of, and if I'm hearing you right, of constantly building utility, whether it's a centralized team and also the community, but you're in this attention game and you want to constantly build utility. How do you think of that this token fits into that equation? And what is the business model, or what do you think this token? What do you think the purpose of this token is? I'm curious to get your thoughts on this.
It's early. I don't know. is my short answer. I have some ideas, some guesses maybe. So like again, I think Lee touched on this earlier, but ownership is a spectrum, right? There's different ways you can experience ownership. There's on maybe just to simplify, there's sort of like the economic sort of rights or economic value of ownership, and then there's sort of the governance or control value of ownership. And I think what and there's others too, like status and sort of belonging, and there's all these things sort of bundled into the experience of owning something that are important. And I think maybe the dichotomy of having sort of NFTs versus a fungible sort of governance token allows the Bored Ape community to explore these different dimensions sort of in parallel, maybe by unbundling them from a single asset class. Right. So like perhaps just speculating, maybe the drift over time is that the NFTs are more experiential, more about belonging and membership, and the fungible ape token is more about governance, control, and economics, right, and cash flows. That's one possible future, and I think it's an interesting question to ask is, why not, keep it all packaged into one, keep all the value in a single asset versus fragmenting it? The answer may be just simply that there's different stakeholders in the ecosystem that gravitate towards participating in different ways. And so, by unbundling the two, you actually grow the base of like who can participate and how active they can be, because there's different sort of barriers to entry with each of the assets respectively.
Do you think that dilutes the value of the NFT? Because I've always felt, back to DeFi, DeFi in many ways was a game. You were yield farming. It felt fun. You were anyone that I remember, I Paraswap yield farming yams. I mean, it's this sort of gamification of finance. It was fun in many ways. But I think the emotional cachet of an NFT, of the sport of collecting, is really strong. Whereas money does not have emotional cachet as much as a piece of art or an NFT. And I think and so I'm curious, like in the internet phase, we see this bundling and unbundling constantly. I'm not sure I guess the question, does this dilute the whole reason of existence? Why even have an ape at this point?
I think like one of the other axes of ownership, when we talk about ownership as a spectrum of experiences, is also ranging from the individual all the way to the collective. So NFTs offer a very individual experience of ownership. You get exposures to that one particular asset that you own. And now what we're seeing in that community is people are taking their NFT, their Bored Ape, and creating like entirely new enterprises on top of it. Like Jenkins the Ballet has now signed with, I forgot, CAA or ETA or whichever talent agency, and is now going to become like his own personality and have lots of media entities around him. But that is like a very specific type of ownership where like, I myself own this thing and I benefit from the value appreciation of this one thing. Whereas the ape token is a more community driven experience of membership where everyone owns something fungible and everyone stands to benefit from the appreciation, or everyone stands to lose if there's depreciation in the value of the ape token. So I think it's just a different flavor of ownership, and that then compels and incentivizes people to build in different ways. And I think that has not yet begun to be explored. I think they've talked about how this is going to be the token that underlies like potential future games or media assets that they build around the entire collective set of IP. But yeah, that's another way that I think about NFTs versus these fungible tokens.
One other like mental model or analogy that might be useful here is the concept of sort of different classes of stock in a company, right? Each each having different sort of governance rights and economic rights and so on. I think like something we may start to see more of in the NFT community, maybe in DeFi or DAOs broadly, is this concept of having different classes of owners. And again, like where each class offers a different experience or different benefits to the respective stakeholders. So earlier we were talking about how maybe some creators don't want to be owners, right? Or don't want the responsibility of having to make decisions. They just want to sort of make their income, or they just want to focus on building their business. So maybe that kind of experience is more well suited to, you own a single NFT and you're building a business around that NFT, but you want nothing to do with the sort of like overall governance. Maybe that's handled by the ape token. And maybe what you start to see is, interesting combinations or composability of what you do with these different asset classes. So for example, maybe if you own an NFT and you have ape tokens, your vote counts for more than someone who simply owns ape tokens and doesn't own an NFT, right? And because that person's more invested or has a different level of skin in the game. And as a result, you can have, for example, speculators who purely own the ape token for financial purposes. And then separately, you can have people who are really invested in the community, who bought an asset, built a business around it. Their vote counts for more. That allows the community to, of people who are truly invested, to express the values that they want, and maybe have those values supersede the values of pure financial speculators. So I think there's a lot of interesting design space that's sort of underexplored with what you can do with different classes of ownership within these communities.
The last thing I want to actually just wrap this up with is the last topic is social tokens, actually. And Lee, maybe I'd ask you are you guys at Variant investing in any social token projects? And B, do you see social tokens as a prominent part of the creator economy and ownership economy?
Yeah, I think NFTs are social tokens. Like NFTs as they're being leveraged right now are social tokens. A lot of what we had thought about and written about and everyone had been conjecturing about what social tokens could enable creators to do, that has come to fruition, but through the form of NFTs. So, and I think a lot of that ties back to what you were remarking on, Santi, about the emotional resonance that a piece of art or creative work has versus like a more abstract token that just has a ticker symbol. But yeah, I think there's countless examples out there of creators whose communities have come together around their creative output in the form of NFTs, and where the token itself functions as kind of like the thing that bonds everyone together, and through which they're able to access different experiences and benefit from the success of that particular creator.
So do you think that I see what you're saying, Lee? Like you and you had this in the post, like 100 true fans. You've got the speculators, casual fans, active fans, super fans, and then what was the top one? Cult fans. And I see what you're saying. Like you can issue NFTs, and those like there'll be a range of prices that people pay, and maybe those cult fans are the ones that pay $100,000 for your NFT. Do you see social tokens in the way that oh man, who was the guy a couple of years ago who issued a social token for himself? I'm forgetting.
Alex?
I forget his name. Yeah, Alex. Yeah, exactly.
Alex
Do you see?
Message, yeah.
Yes, exactly. Do you see social tokens in that way taking off, where fans get to like almost vote on your life or anything? And the reason I'm asking is when there's this thing that we've probably all had here, maybe with like if you're into music, or maybe if you're into like Instagram, where you want to tell your friends, you're like, oh, I found that Instagram account early, or oh, I listened to that song early, and it seems like a way to maybe capture that upside from the financial lens is social tokens in the way that like Alex Message did it. But what maybe you're saying is, yes, you're right, but we have that. It's called NFTs.
Yeah, that is what I'm saying, the latter. I think the former with like a fungible token that represents that particular person's career, and I think Alex even baked in perhaps a revenue share to it from his income. I think that, yeah, that is still very much like, I think on the fringes of what I'm seeing, and it's not very common. I think there's a lot of like creator trepidation around that model, because it feels very much like they are commoditizing themselves as a person, and this token will literally be floating out there forever as a tracker of their success level. And that's a lot of pressure for a person to undertake, versus NFTs, I think, have a closer comp, which is just like all of the creative output that people had already been selling. They're used to monetizing through their creative output. And it does also function as a tracker of their success as a creator. And so I think NFTs are taking on the functions that we thought social tokens would.
Sorry, one quick addendum to that is maybe this comes back around though in the same way that it came back around with Bored Apes, which started with NFTs and then launched a governance token later. Maybe the opportunity is for artists, creators to progressively decentralize, start with a product that people want, which maybe is NFTs that open up some kind of new access or experience for engaging with their audience. And then once you have this product, you progressively decentralize that and launch a token associated with the product. But the critical difference here, you're not just tokenizing the person, you're tokenizing the product that the person launched. And as you get something that looks kind of like a social token, but is not the same as what Alex was doing, which was tokenizing himself.
I want to touch on 2 points. One is this idea of retention. In DeFi, and you both touched on this, it feels very mercenary the way it's currently structured. It doesn't feel like any of these protocols, most of them haven't really focused on retaining users. And maybe it's a function of building usable products, and it's a very small subset of people that actually think about all day about liquidity mining and capturing yield on chain. There's no users. And so I'm curious for these NFT communities, Bored Apes. Jason and I were talking last week. I think now you're going to see an influx of projects, Doodles, and all the others that are going to probably launch their token, and it's going to, probably there's a speculative mania attached to that, which is, oh, let's go buy the next set of JPEGs because there's going to be an airdrop and you're playing this game. I'm curious, like, you look at the evolution of certain social networks, like Facebook kind of died off in many ways. Instagram is probably still going strong, and Twitter is, pretty strong. But I think over time, retention becomes an issue for these networks. Do you think that changes because of ownership and more direct ownership, and people have more incentive to stick around? Or is this also going to be a problem for kind of Web3 native communities and protocols?
I'm gonna answer this by coming back to the city analogy, right? So I think that the difference between Web 2 social networks or Web 2 platforms broadly, crypto networks, is the difference between Disneyland and New York City, right? Where one has sort of permissionless, market-driven innovation and sort of renewal, and the other, Disneyland, is top-down controlled, walled garden, can't build new stuff. So the critical difference is, like, the talent that exists within a single company. It is only so many people in the world, right? Like, and the barrier to innovating is getting a job at the company, getting buy-in, innovator's dilemma, overcoming that. That's why Web2 platforms stagnate and die. New York City as yet has not died. It's had many near-death experiences in the 70s, and when it nearly went bankrupt and so on. But the thing that is amazing about New York and many other cities is, like, they're constantly able to reinvent themselves. And again, that's because it's permissionless, market-driven innovation. I think a lot of crypto networks will feature the same. It's not, of course, like all analogies break at some point. I think the way
this
in
is sort
which,
of like a cathedral in the bazaar kind of construct of open source networks.
Totally right, and I think so the way that crypto networks reinvent themselves over time may be different in that it's not bound by a physical location. You can fork, right? You can airdrop and so on. So, but like, nonetheless, I think they will continue to evolve and reinvent themselves, and that's one of the principal reasons I have very high conviction long run Web3 platforms grow bigger and ultimately beat out things that are not building in this model, because they're competing on very different terms.
The second point that I want to touch on briefly is this idea of IP, which I think is radically changing in how we think about it in the context of just this open source, creative, common kind of chaos. There's a lot of still artists out there that are skeptical of moving on to this model. What would be kind of for anyone listening out there that's deeply skeptical of NFTs or going this route, like, what would be your kind of response to that, or what would you say to them?
Distribution is king, and the way the internet works is that the more eyeballs you can get, generally, the more ways there are to monetize. In the past, that monetization has been indirect, right? You first have to capture attention in order to drive that attention towards monetization through some other channel. That's the story of Instagram influencers and the like. Now it's possible to convert attention directly into monetization by selling the canonical instance of the thing that is being distributed widely on the internet. The best way to get something distributed widely on the internet is make it permissionless to do so. So remove the concept of copyright, allow it to be infinitely copy pasted and propagate widely, and reap the benefits of doing so by selling the canonical internet native version or instance of that idea. And everyone talks about the Mona Lisa, but I think it's a very good example. Most widely reproduced image on the planet. You can't really value owning the canonical, the one that's hanging in the Louvre, right? And I think most media assets are going to follow the same trajectory, where the goal is going to be get it reproduced with as little friction as possible, so most eyeballs can see it, because that directly correlates to the value of the underlying NFT.
Yeah, and now you can distinctly and uniquely, like, prove this provenance of creation, and also even if there are derivatives, you could still monetize in many different ways, many of which we may not have even seen or explored. Which is, now we're seeing tokens on top of NFT projects, and so feels like a very wide open design space. But nonetheless, we're getting meaningful attention and traction, and so distribution is building quickly.
Jesse, this has been awesome. I want to actually wrap with one. We never do this, but one action item for everyone listening, because you guys are have invested in so many B2C platforms. So one action item for users to do: go to a platform, do a Web3 interaction, collect something. Where should folks go? Lee, maybe if you want to kick us off.
Yeah, I wrote a tweet storm about this a while ago about getting into Web3 with recommendations for products that people could play with. I think my advice to everyone is, like, if you want to learn more about crypto, just participate and get in there and use these apps. So on the consumer side, I would point them to platforms like Foundation for collecting NFTs, Sound Catalog for music NFTs, Form Function for NFTs on Solana, Context for browsing what other people are doing on chain, Mirror for publishing posts and perhaps crowdfunding creative work. Yeah, you can check out our portfolio, by the way, on variant.fund/portfolio. We have a list of companies that you can check out.
Yeah, and I would just add, on that list, you'll find things outside of the creator ownership economy, but also in other categories like DeFi and low-level infrastructure, where there are ways to participate and earn ownership as well. And I think one good example that touches on a lot of the themes we covered today is Grow Protocol, which allows you to in a low stakes way earn yield on US dollar stable coins, and in exchange for doing that, earn a piece of the underlying money marketplace through the Grow token, which does actually have a vesting mechanism that aligns individual users with the long-term success of the platform.
Awesome. Lee, Jesse, this has been awesome. Variant is truly leading the way, and I've loved everything that you guys have done since launching, and it's been really fun to see what you guys are doing. So thank you both for your time, and I think everyone, Santi and I, are rooting for you guys, and I think everyone listening to this is rooting for both of you. So yeah, keep up the good work.
Thanks so much for having us.
Yeah, this is great. Great questions.
Thanks, guys, for coming on.